welcome to Voice of Pacificwide. And again, today we have TJ with us. Hi, TJ. Please say hi to our audience.
Hello, everybody. Top of the new year. Glad you could join us.
All right. So today, TJ will continue going over real estate investment. But before he goes deeper into real estate investment, he will talk about why real estate investment instead of some other kinds of investment. So I'm gonna let DJ to jump in right away. Okay, so go ahead.
Thank you, MC. I mean, you're certainly welcome to interrupt me anytime or ask questions. You know, I have no problem. I wanna make sure we really disseminate this information and it's all very clear to everybody. We were talking about investment basics. We were talking about the basic concepts, principles, and practices of real estate investment, tried and true methods and methodologies to climb the housing ladder. There's really a lot of great information here that we'd love to share. So we're going to go through this slowly. Back to where we were last week, we were just talking about the basics, the fundamentals. You know, obviously home ownership is probably 80-90% of real estate investments, and then obviously being a landlord and having rentals or going out and pursuing distressed properties to flip those short term, or just getting involved in real estate trusts where it's just completely a passive type of investment. And then there's also the short term we talked about also, as well as like Airbnb vacations. But so at the bottom of this chart here, if you could flip to the charts there, Michaela, thank you. So I show an example here of the S&P 500, which is really an indicator of an aggregate of stocks in the U.S. stock market. It shows the performance going from like 0% to 250% over 17 years. You know, that's the S&P 500 in the blue squiggle there. And then a Vanguard mutual fund, which is all real estate, and you can see that they actually track each other really good. So the Vanguard real estate mutual fund would be the same as that investment number 4 up there, where it's a passive investment. Somebody else basically does all the management and ownership. You don't really own the property except paper, kind of like stocks, like paper. Anyway, so. The stock market actually has done pretty good. If you take a look at this, it's gone up 250% over 17 years, which is great. So every dollar you put in, you get like $2.50 back. Again, that's great. You know, I mean, the economy's been doing pretty darn good.
But you're talking about long-term stock investments, right?
Over 17 years. I mean, everything like we said last week, everything that goes up must come down. So there's a downside to everything, including the stock market. You can see on that the chart there where the Great Recession was back in 2010, and there was a pretty significant drop in the stock market. You know, I mean, aggregated, it dropped maybe in half or so. So your investments went negative on you. That doesn't happen too often in real estate, but there's a correlation what happened in the stock market, the Great Recession, and then also what happened in the real estate market. And we do talk about that a little more downstream to give you an indication of there is the opposite of appreciation. There is depreciation, where your investment can actually go down. Your return on investment can be negative. That can happen. Doesn't happen very often. Okay, mm-hmm. And then if you're just like day trading on stocks, well, of course it can go up and down every day. Then it's a reality that stocks go up and down every day with every minute as the clock is ticking, right? So you have to be a pretty savvy investor to do that day trading. Have the stomach for it. But if you take a look at this chart, my point here was so the average return on investment, if you did a straight interest, would be like almost 15%. If you do compound interest, it's like 5.5% per year. Financial planners, if they're going to run some numbers for you, they typically like to use 5% as your return on investment, compounded interest, right? So now let's just do an apples to apples comparison here, okay? I really wanted this to resonate with everybody. I want to drive this point home. I want everybody to understand why it is so important to make real estate part of your investment portfolio. not only because it is a real tangible asset, okay, you can get your arms around it, right? You can live there, you can stay there, you can have friends over, you can have parties there, okay? You know, you don't have to pay rent, so there's a lot of advantage to owning your own real estate. But let's just look at the dollar side, okay? So on the bottom right hand of this chart right here, I say, okay, for instance, let's say we do 100K cash investment, okay, at 5.5% compound interest, and I just showed that the stock market has been averaging about that, so that's reasonable. 5.5% compound interest over 10 years, and FYI, the real estate market in San Jose doubled in the last 10 years. So the market really out here is really not 5.5, it's almost more like 7.5 or something like that. But just for comparison purposes, apple to apples with the stock market, let's look at that. So you can take 100K and you can go out and buy some stock, right? And 10 years later, you're going to have 171K based on the average S&P doing 5.5%, right? So now you net 71K. Okay, great. If you got to pull that out, well, you're not going to be with 71K, right? Because you're going to get hit with short-term or long-term capital gains on that. So, you know, a lot of that disappears. But let's say conversely, you take that 100K and you put that into real estate, so you do a 20% down payment with 100K will get you a $500,000 home, right? So even though you put 100K in, and then you leverage the bank for the other 400K, and your total investment here, your total holding really is 500K, because you're leveraging somebody else's money, right? In the stock market, you put 100K in. In the real estate, you put 100K in, but that's only 20% of the fair market value, right? You're actually sitting on a $500,000 home. So now let's appreciate a $500,000 home at 5.5% interest for 10 years, right? And voila, you're over, 850K. You've made 350K, okay, in the last 10 years. And not only that, you're not paying rent, and all the interest you're paying, you're writing it off on your tax returns, right? So it isn't really costing you anything to hold that investment for the 10 years. In fact, you get benefits from it. And then when you sell it 10 years later, your net is 350K. Do you have to pay taxes on that? Well, the answer is no, because there's this capital gain exclusion. If you're single, you're allowed up to 250K, $250,000. If you're married, you're allowed up to $500,000 in capital gains exclusion. So not only do you get like 5 times the return on your investment over those 10 years, but when you pull it out, you don't pay taxes on it.
So this
okay.
is
I mean, how
really,
sweet is that? Okay.
This is really awesome, and I want to open up some points that TJ just shared with us. I want to expand it a little bit. Some people might not agree with us on the scenario that TJ just threw out, because some people might do really well in stock market. They make millions of dollars in stock markets.
It happens,
but
yes.
that number is like really small. Like, and that person had to be really, really good at what he does. Like, he had to know a lot of things that I don't know. They have to understand, they have to read news, they have to understand how the economy works, they have to have the big brain to invest in stock to make lots of money. And I know some people, they spend their full time doing stocks. They don't work. They just spend all their time just stocks. Is their job, their career. And they make so much money, right? But that number of people are not many, and not many people can do that. That number of people who's very successful in stock investment is not much, and they have to know almost everything to be able to win in that game. But in real estate, all you need to do is just to buy a home and live in it, and 10 years later you gain so much, right?
That's right. Time is on your side. As
Exactly.
we said, appreciation.
And the example that TJ throw out is for someone who put in 100,000 and 10 years later he earned 71,000. That scenario for someone who know nothing about stock and don't do anything about stock.
That's right.
Just put 100,000 in, and that how much they earn later. So that scenario compared to the scenario of someone who own a home and they don't do anything, they just live in that home. They pay the mortgage. That's easy, right? You have to pay your mortgage. If you don't live in a home that you own, you have to pay your rent. So same thing. You just have to pay your mortgage, and that payment, you know, it's include your principal and interest, and the principal is your equity. On top of that, you whatever interest you pay out, you can claim it your tax deductible, like TJ just mentioned it. So this scenario is for the people who do nothing. It's just owning a home, or the people who buy stock and they don't need to do anything with that stock. They just let it be, and 10 years later they earn 71,000. Same thing, the owner of the home, they do nothing, they just live in the home, and 10 years later they gain at least $345,000. So that's the scenario.
Right. Excellent. I mean, this is your basic buy and hold strategy. Buy and hold long term. You know, there's a lot of different investment strategies, but this is just buy and hold. It doesn't matter if it's stocks or real estate. You're just buying and holding it, and you're going to hold it for 10 years. Now, you know, I use 5.5% compound interest here because that's the average of the S&P 500, right, over the last 17 years. Well, in San Jose, over the last 10 years, property has doubled. It's like 7.5%. So if you would have got a $500,000 home 10 years later, it would have been $1 million. And you would have made $500,000.
That's
and that would have been all capital gains exclusion if you're married and you hold the house for more than 1 year. Long-term capital gains exclusion, you don't even pay any taxes on that.
That's right.
I mean, what a great business plan that is. And you can keep doing that over and over again. Take that 500 and start trading up. I mean, that's where it becomes kind of tried and true, where it's like almost 100% guarantee you're going to get a good return on your investment. Now, you can't really say that in the stock market.
Right.
Okay? But in real estate here in the Bay Area, it's a definite.
And I also think I see a lot of real life story that people who own a home in 10 years, they make in the Bay Area, their home appreciation is increased over $1 million. I see that like from left to right, everybody around me. So if you don't know any of them, because you didn't ask, if you go around the people you know who live in the Bay Area and they own home more than 10 years, and you ask them to see the home appreciation 10 years, how much do they get for holding a home for 10 years? You can just ask people, random people who live in the Bay Area who own home, and you will have the exact number. For me, because I'm in this career, I see that every day, it's normal. But if for someone that don't know anybody yet, it's just because you didn't ask, you didn't pay attention. If you ask and pay attention to those homeowners in the Bay Area, you will see it. And the reason I mention it because I want to show you that real estate investment is the number one investment that will help you to build so much wealth in like 10 years or so, because in the past, right, our parents teach us to save money, put money in the bank, and let that grow. Imagine you save 100,000, you put it in your bank account. How much you gonna get 10 years later? Nothing, right?
1%, 2%. Yeah,
so it's nothing. So and if we do stock, if we don't know how to do stock investment, we might lose every dollar.
Right.
We lose all.
It's gone.
For me, I did try to invest in stock, and I lost every penny I put in there.
Ouch.
Yeah. And even my husband, Leon, he is he used to be working for a high-tech company. He's an engineer, software engineer. He knows about stock. He knows everything.
Right.
But, he still didn't make it.
That's right. Sometimes it's a little stroke of luck. Well, if you would have been heavily vested in Tesla, before the inauguration and after President Trump's inauguration, his Tesla stock jumped up 15%. The day of the inauguration. So, sometimes you just get lucky and you hit a hot one.
So we have to be lucky, right?
But it's not even economics. That's pure politics, okay?
I know.
Stock went up purely on politics, not economics. Real estate grows with economics, okay, with the economy, okay? It's not really tied
And
to
it's
politics.
more real, right? Real estate is more real.
That's why they call it a real tangible asset. Like I said, I can fix it up, I can decorate it, I can paint it, I can have parties there for my friends, raise my family, et cetera, et cetera. I mean, there's so many.
So just go back to my own story. Just want to share my personal story, like Leon and myself. Because Leon and we both used to work for a high-tech company. We are engineering people, and we did invest in stock, and we lost all of our money.
Ouch.
Talking about $100,000 back there 20 years ago.
Wow.
And that's why when we get into a real estate industry and we invest in home, and we are so happy and we make so much money from the home we own, the home we live in, the home we rent out. That's why I love real estate. I am passionate about real estate.
I agree. I agree. That's why I'm here teaching. I want to share the knowledge, share the love. I want everyone to get on board here. The very first bullet on this chart says, you know, real estate is its own asset class. It's a real tangible asset, many advantages to it, right? And it should be part of a well-diversified portfolio, right? So I don't care if you pick up 401k and some stock, but as soon as you got enough money for a down payment, first-time home buyer, get in. Okay? I think I bought my first one-bedroom condo when I was like 25, 26 years old.
Oh, wow.
Okay.
You did well.
Well, right.
Wow, you did well.
So, you know, it's never too early, you know. I mean, you know you're
and never too late, too.
It's never too late. And you think you're going to hunker down and stay in an area. Well, definitely, go get a home. Don't rent if you're going to be in an area for 3, 4, 5 years, whatever, especially here. You know, maybe the rest of the country is pretty flat, but here it's a win-win. If you have the day job and you can qualify for the loan. So like I said, as soon as you have that down payment, you need to run the ratios, you know, your debt ratios, and talk to MC here and find out what kind of package program they can get you into. Because the sooner you can get into that first home, I don't care if it's a one-bedroom condo or a 3-bedroom townhouse or whatever, that's how you start, okay? And, you know, do that every 10 years, trade up. I mean, you know, it's a surefire way. Okay, and that you're going to build incredible wealth. You know,
I think as DJ, I want to jump in a little bit here. I want to say this. It used to be like only like adult would want to go, like old people would like to go invest in real estate. But nowadays, like young people, they invest in real estate. They're so smart. Young people are so smart right now. That's why most of our homeowners now are very young. Like the percentage of homeowner, the one who first-time home buyer nowadays is like between 25 to 30.
Yeah.
Very young people. That's amazing.
Yeah,
and I have to say, I have to give you a big round of applause for that, because that's amazing that you're doing the right thing.
That's right.
And if you are one of the young people that already own a home or looking to buy a home right now, you should be proud of yourself. And if any of you like thinking of buying and not sure if you can buy a home, contact me. I can help you. I can go through all your document, like income, assets, and stuff like that, to find out if you qualify, and I can show you step by step how to get a home. It's gonna be easy if you work with somebody professional who know what they're doing. You know, do not try to do it yourself. This is not something you want to do it yourself, because it's a process. It's complicated, and you won't enjoy the process if you don't know what it is. You're gonna be scared. Instead, you should work with professional, somebody with experience, a long time experience, so that it make it easy and you will enjoy it more.
Right.
And you can always call me or go to Pacificwide.com, find one of the agents that you want to work with.
Right. And any of this information here, if it resonates with you, we have the chart package. This is a public domain. I have references on every one of my charts where I pull all this information from. So, you know, if you need a copy of the charts, the slides, a PDF file, whatever, reach out to Pacificwide. We're more than happy to share with you this information. You can go over it yourself. You can call us. We're more than happy to accommodate you on this real estate journey. But definitely get in as soon as possible. Yeah, like I said yesterday, you know. Okay, let's move on here. So getting into some real basic strategies here. Here's 5 of them. We did talk about long-term buy and hold. That's probably the most easiest for everybody to understand, whether it's stocks or whatever, right? You purchase a property, you hold on to it for a long time, it could be your entire lifetime, okay? And in 30 years in the Bay Area, it'll go up like 10x or something ridiculous, you know. Having your own property, your own comfort, your own home is wonderful. You get the appreciation, you get the tax write-offs, right? And if you want to do some home hacking, meaning start renting a room here and a room there, and then all the kids grow up and you got 3 empty bedrooms, you start renting them out. All of a sudden, next thing you know, you got, quite a bit of cash flow going on. And you can start getting the tax benefits. Then you might want to play around with getting into being a landlord, okay, and buying multifamily homes. Maybe you live in one, rent out the other ones. I mean, there's lots of different scenarios. Short-term buy would be kind of fix and flip, meaning you look for distressed properties, you try to get a sweet deal on it, you get in there, you do the renovations, the high value improvements, meaning, kitchens and baths basically, right? Whatever, floors, doors, windows, roofs, upgrade the plumbing, go all copper, new ABS and all the drains, whatever. You get in there and you try to flip it in 6 months or so, where you do pretty heavy, serious construction. Okay, a lot of people do make a business model out of that, and that's a tough model because even distressed properties here, your doghouse here still sells for $1 million. So where's the profit margin? And it's unfortunate, but that's just the way it is in the Bay Area. There's just not much margin for flipping because of the value of the land and homes here. So it's I don't know.
People are still doing it. They still make some money.
That's right. You can still do it, but I think that's a tough field to be in. I keep saying I wouldn't make it flipping your day job, but buying and holding real estate and keeping your day job. Okay, that's the more typical scenario that 99% of people do.
Yeah, but I see this if for people who do construction, right? People who do construction, and if you want to flip home, that's perfect for them because that's their job. They build home, they do things like that.
Right.
And if you need a mortgage to flip home, we have that program.
Right.
So you can borrow a loan for 3 months or 4 months.
Yeah, take out loans, short-term loans,
remodel the home.
Loans.
You turn it around, you sell it, you make money. I have that kind of loan here. It's called flip loan.
Flip loans. Okay.
Yeah, it's fix and flip.
Interesting.
So you can borrow that money and fix it and flip it.
Right.
It's called fix and flip loan.
Yeah.
So if you need that kind of loan, you can always contact me. I can do that for you.
Right. Fantastic. Now, any savvy general contractor should always be looking for, a quick fixer-upper and a quick flip. Okay.
Yeah,
I mean, there's no doubt about it. If I was a general contractor, that's what I'd be doing, but I'm not. And I've done enough construction. Okay, I'm kind of done with that too. Then another, more interesting modern approach to investing in real estate is called wholesaling. It's really not investing. Once again, you're using somebody else's money to buy the property. So wholesaling is kind of more like a finder's fee that you can get, by connecting the dots between a buyer and seller, kind of acting like the middleman, getting a finder's fee. You don't have to study real estate. You don't have to be a real estate agent. You don't have to be licensed. So, some people actually do this where they actually will also look for distressed properties or foreclosed properties and start knocking around and seeing if they can hook up investors with distressed properties to get a quick sale. That's kind of a finder's fee. We can talk more about that.
But I think for this kind of investment, is it some pro and con here, right?
Oh yeah, totally.
Of course, right? Because when somebody, they not real estate people, they don't do the real estate every day, and they help somebody to sell the home. The seller might not know what they're missing or what they lose. Because when this real estate agent is more like professional and know exactly what to do to help you to make most profit from selling your home. But if somebody else not professional, not real estate people, maybe that's not a good way of doing it.
That's correct.
Yeah.
Correct. So the wholesaling is typically more targeted for quick sales, cash sales, this type of audience, this type of investment. It's not the traditional, we're going to do a 30-day close and escrow and stuff like that. And not all companies will actually accommodate wholesaling. One approach to wholesaling is do what they call a double close, meaning you buy it and you sell it the same day. You do a double close in escrow.
I see.
That's one way to do it. Another way people do wholesaling is they do an assignment contract. It's not in a purchase agreement. It's an assignment contract, meaning I'm going to assign the right to buy this property to Michaela over here, even though I have the assignment contract, and on top of that, I'm going to get a finder's fee or something like that if she buys it. So that's another way to swing a wholesale deal without using any of your own money, because now you're just assigning the contract to somebody else.
I see.
Okay, so versus a double close, you pretty much have to buy it, gets hard money.
But
or
honestly,
something.
I don't see this a lot.
I don't see it either.
I never see. Actually, I don't see it at all in my 20 years or more of doing real estate. I don't see it.
Right, but it exists. It is a strategy. Some people do it. When I was first getting into real estate, I was constantly looking for, foreclosures, default properties, tax sales, auctions, you name it, totally unconventional, looking for those crack deals. In that sense, I was kind of making myself a wholesaler where I was trying to get in there and find a good deal, but I was the one who was buying it, not trying to, sell it to somebody else, an investor. I was the investor, whatever, like that. So in a sense, there's good and bad from all of it. I mean, there are some advantages to really understanding that. But I've only been asked once, too, about wholesaling. So I don't think it's really, very popular. Like I said, obviously 90% of people are doing the long-term buy and hold. Okay, maybe 1% are doing, fix and flip. Probably less than 1% are doing wholesaling, right? There's probably more people on the fourth item here, the Airbnb vacation rentals. That's become very popular in the Bay Area.
It is.
And obviously in tourist places as well. You can have a second home. It can be a vacation home. You can rent it out. There's some tax advantages and benefits to that. Especially if you're in a high-dense tourist area like, Monterey or, right off Fisherman's Wharf or someplace where, there's a large influx of tourists and tourism and the hotels are always booked, you're going to get some bank. Okay, if you can keep your Airbnb booked out and charge double what a hotel is in the area, I mean, you're definitely going to make some bank, I mean, I haven't done it yet. I haven't done short-term rentals. Short-term is considered 30 years or less, 30 days or less. Less than 1 month is considered short-term. After that, it's considered a long-term lease. I pretty much do all long-term, in my rentals. But if you got a unique property or a very unique, desirable location, doing vacation properties is becoming very popular. Platforms like Airbnb and, VRBO, they've made a killing in this market. I mean, Airbnb's made a killing.
Airbnb making so much money. Because I myself also do Airbnb for our properties, and also we know a lot of people do Airbnb nowadays. They have, and because why people love the Airbnb, it's so much cash flow. If you rent a home, like the person who rent your home will pay you by night, like every single night. They have to pay you.
That's right. It's a nightly fee, and probably
it's really good money though.
Hotels are at $100 a night, so you get $100 a night. You're doing $3,000 on one room. Yeah.
So it actually it's really amazing with the Airbnb business right now. And if you, the property that we rented like $2,000 a night. And some people they can, and in high season it's $5,000 a night.
Yeah.
And people rented like 10 nights in a row. Oh my God, amazing! Like we didn't even expect that somebody rent 10 nights in a row for $5,000 a night.
Yeah, incredible.
This is amazing money. Yeah. And if you ever thinking, oh my God, this is awesome, I want to do Airbnb rental, and I don't know what to do, you can always call me because I'm doing this myself. I can show you step by step how to do Airbnb rental. It's really easy. Just call me or one of the agent in the real estate company, Pacificwide company.
Right. So, those are very popular. Airbnb, the vacation rentals. Then getting down the last one here on the strategy is commercial real estate. Right. Basically, income producing property. In California, as far as I know, anything over a fourplex, over 4 units, when you get into 5 units, it becomes commercial, and you need the commercial loan for that. You don't necessarily have to be a commercial entity, but most banks do like to see a commercial entity, whether it's an LCC or something like that, set up or structured to handle commercial properties. But commercial properties are not only multifamily, 5 units or more, but obviously office buildings, brick and mortar, strip malls, retail centers that we see here. And I already mentioned large multifamily apartment complexes, right? Those get into different kinds of lease. You get triple net leases. I mean, if you got a really good deal on some commercial real estate and you got a good business in there that's very successful, you can definitely make some good money in commercial real estate.
For the commercial real estate, it's really easy. If you want to get into commercial real estate, it's really easy to do. You don't have to be a LLC, whatever. Just anybody can borrow a commercial loans. At Pacificwide, we also do commercial loan. There are 2 different types of commercial loan. One is what is it? Business. Like if you are owner of the business, right, and you own a commercial building, and you can borrow money as an owner of that building. I think it's called SB, right?
Like a small business.
Small business commercial loan, yeah.
Okay.
And or you can just, or if you just buy a commercial property, you rent it out. You can also borrow money for that commercial property. But commercial loan is really different from residential loan. For residential loan, all we care is the person who borrowed the money to buy the property. So mostly we pay attention to your income,
right?
Your credits. Right. But when you borrow a commercial loan, we will look at your income and we look at the property income. And the property income in this case is more important because from the lender eyes, commercial property is the income producer property. So the property had to produce income to qualify for a loan. So if you buy a property that vacant, that no rent at the moment, then that property doesn't produce any income, that property will have a very hard time to borrow money. Mostly the conventional lender, they won't lend that property. But we have something else, like different kind of lender will lend those money. So we work with so many different type of lender that okay with property that don't produce any income, we can still lend that too. So if you happen to buy a vacant property, a commercial property that have no rent at the moment, we can help you too, because it's hard for somebody to go to like a regular bank and then say, I have a property that I want to buy. It's have no rental income at the moment. You don't just get that loan from anywhere. You have to know a broker like us, because we are broker. We work with all kind of different lenders, and we are able to provide you all kind of loans. Residential loan, commercial loan, we can do both, conventional or non-conventional. So if you ever have any question regarding to commercial loan or residential loan, you can always contact me or one of the agents at pacificwide.com. And by the way, how do we define commercial? Because I think TJ already talked about it. But the easiest way to define commercial is whatever not 1 to 4 unit are commercial. Like 1 unit, single family home, duplex, triplex, fourplex, they are not commercial.
Right.
But anything that not 1 to 4 unit, then they are commercial. Okay, and then you need a commercial loan to buy them.
Right, and you typically put an extra point or whatever on that, and you're typically dealing with jumbo loans, so it's a different market.
Yeah.
It's a different business model.
Yes.
Getting into commercial. I don't know if you want to say anything else, but the rest of these, basic strategies, getting into business strategies and stuff here.
We're going to do it next time.
Yeah, we've talked about these, I think, quite a bit. I mean, these are just kind of drilling down deeper into it, give you more examples. And then we could probably wrap up today with the benefits real quick. And then next week we'll start with some definitions in real estate appreciation, equity, leveraging, Okay, really help people understand these basic concepts. So
Yeah, we're gonna do it next week.
yeah, next week.
By the way, next week we're gonna move our show time and date time to Thursday. So from starting next week, we're gonna do our show on Thursday, still at 12 noon, but it's Thursday. Okay?
That's right. We have Lunar New Year next week,
Next
right?
Wednesday.
So we have a special treat for you. Okay, we're going to put together a little lucky money, and the first person who calls in or texts here is going to be the winner of that lucky money next week.
Yeah.
So stay tuned. Make sure you dial in and you're ready to go. First thing when we start the class, when is the
12 noon on Thursday next week.
Okay, next week Thursday 12 noon, which is what, the 30th?
No, next.
Yes.
Oh, that
The 30th? Next Thursday will be the 30th, right? So
Do we have 30th?
Stay tuned.
No,
Yes.
we do have the 30th. Okay.
Ted's coming. We got some lucky money for you, and there's going to be one really happy person.
Awesome.
So stay
awesome.
tuned. So anyways, okay, let's finish this off real quick. Just getting, rehashing a little bit, getting into the advantages here, then we'll wrap it up. Obviously, any investment has advantages and disadvantages. So let's talk real quick about the pros and cons. The advantages, I think everybody understands. When you're a landlord or you're renting or you have commercial property, there's cash flow. There's monthly income coming in, and like you were saying, if it's an Airbnb, it's kind of like daily income because you're charging, per day, per night, right? So, major cash flow advantage there, right? If you're into the stock market, you're not getting cash out every day, okay? But admittedly, buying stocks is a lot easier than buying a home, right? Buying stocks you can pretty much do instantly nowadays. Buying a home, typically you'd go through a 30-day escrow process. And then also to offload the home, if you have to follow, protocol. Okay, stocks you can also just boom, I changed my mind, I want to sell. Okay, well, with a home it's not that easy, but it's very still manageable to liquidate, a home and its assets, right? So major tax advantages, whether you're, home ownership with your interest and your property taxes, or if you're a landlord where you can throw in all your utilities and all your repairs and all your maintenance and depreciating the property and, business expenses. So there's, major tax advantages, okay? Versus, again, if you go into the stock market, you make some money, you're going to pay capital gains on it. Right?
Definitely.
And we didn't even talk about here that when you sell it, the capital gains exclusion, it's
amazing.
It's such a sweet deal. Yeah. Like, again, everybody get into it. Real estate hedges against inflation because when, costs go up, the cost of renting goes up, okay, maybe utilities go up, but typically you pass it on to the renters and the home still appreciates over time. So if you hit a rough patch, a year or two of, heavy inflation or whatever, you're going to get right through it. The rents are going to go up and your property is going to go up over time. Maybe it's level for a little while, but, there's still, real estate is like a natural hedge against inflation. Okay. You can't do that in the stock market, right? And then the ability to leverage. Okay. Banks look at real estate as a real asset. It's collateral. Okay, you can borrow against it. Okay, and MC knows all about that. She'd be happy to help you out with that. That's the business she's in. Okay, mortgage business here. So the ability to leverage, and then I came up with this concept of double leverage, meaning you leverage the bank's money to buy it, and then when you want to sell it or trade up, you leverage the bank's money again to pull your equity out. So during the life cycle of a home, you can leverage it twice. How wonderful is that?
So let me expand this a little bit when DJ talk about leverage, the bank money. We all know, even though DJ said at the beginning, the disadvantage of buying a home is you take 30 days, but nowadays it can be shorter, like 20 days or 14 days. It's really amazing that the time of getting a loan done nowadays is really short, like 14 days or 21 days. And to me, that disadvantage is actually not a disadvantage because, first of all, when you buy something like a property, you need some time, to prepare to move into it. You don't just like move into it the next day. So you have some more time there. And also, when you buy stock, you just have whatever amount of money you have, you put it in and you buy it. and you can leverage money, but in the real estate industry, you can leverage money. Meaning you borrow the money from the lender to invest into your property, and most of the time, okay, I say most of the time, not all the time, we have 20% down payment. Look, lender will come up with 80%.
That's right.
If you buy a home of $1 million, right? You only need to put down $200,000.
That's right.
And then the lender have to put in $800,000. And
right.
10 years later, if you double the home value, go to $2 million. Okay, listen. Home you purchase is $1 million. 10 years later, you sell it for $2 million. You gain $1 million. Look, you only put in 200,000 and you gain $1 million. Well, the lender put in $800,000 for your investment. So, look, in America, this is something that's so amazing. That's why I have so much passion into real estate, because I see the power of leveraging your money.
Mm-hmm.
If you have to come up with $1 million to buy that property, and 10 years later you gain $1 million, that's nothing to talk about. But you only put 200,000 in to gain $1 million later. So if somebody tell me, oh, MC, the rate is so high right now, I don't want to buy the property, I want to wait. Do not wait. Do not let the interest rate stop you from buying. Why? Because remember, doesn't matter how much you pay for the lender, 7% interest rate or 6.875%, it's nothing. 10 years later, you gain $1 million.
Right.
Me, I am a real estate person. I work in the industry, real estate, for over 20 years. I also a real estate investor myself. And if I wait for rate to go lower to buy, then I don't think I own as many properties that I currently own right now. I never stop buying. Whenever I have enough down payment and I see a good property, I buy. That's how I build my portfolio of properties. And I never let the rates stop me from buying, even the price. Because if you look into the 60 years of real estate history, in terms of price in the entire country of U.S., you see the price only go up, even though sometimes it go like this zigzag. But if you keep it long enough, it always goes up. So even the home price, I would never let it stop me from buying, or the interest rate. So if you need more information about this, maybe we talk more about this in the next few weeks. We will show you exactly what I mean. Did I just like a little bit give you some summary, right, DJ?
Yeah. So anyways, I want to thank everybody. Thank you so much, and hope you have a wonderful Lunar New Year next week. And please come back to see us, because we have some lucky money for you.
Okay, thank you so much. I'll see you soon next time. Thank you, DJ. Bye-bye.